On March 12, 2023, the FDIC died.
Earth to earth, ashes to ashes, dust to dust.
And with that death came essentially free money for the entire banking industry.
Money, 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 money.
How? Let me explain. First, let's talk about the FDIC. Before the FDIC was established, anyone who deposited their money in a bank account was taking a huge risk.
Absolutely huge.
A risk that their bank could run out of cash due to losses on either its loans or a surge in withdrawal.
You gonna give me my money?
If either of those things happened, it would leave a great deal of people with virtually no options to recover their money. And this fear was for good reason. See, during the panics of 1893 and 1907, many banks filed for bankruptcy due to bank runs.
I declare bankruptcy!
People were well aware of the likelihood of a bank collapsing. This caused the public to call for deposit insurance. So after those panics, 8 states established deposit insurance funds, but small local unit banks grew in numbers, especially in the western and southern states. By the time the Great Depression hit, nearly 1/3 of all US banks had failed. This caused a panic that spread so rapidly that most state governments ordered the closure of all banks.
Oh my God! Okay, it's happening. Everybody stay calm.
What's the
Everybody
procedure,
stay calm.
everyone? What's the procedure?
Stay calm!
Wait.
Everybody calm down!
After the Great Depression of 1929, President Roosevelt needed to find a way to restore faith in the banking sector. Though he was uneasy about insuring deposits, he signed the Banking Act of 1933 into law, creating the FDIC, the Federal Deposit Insurance Corporation. The initial plan set by Congress in 1934 was to insure deposits up to $2,500, but it was increased to $5,000.
Now we're talking.
The Banking Act of 1935 made the FDIC a permanent agency of the government and provided permanent deposit insurance maintained at the $5,000 level. Now, the per depositor insurance limit has increased over time to accommodate inflation, and Congress approved a temporary increase in the deposit insurance limit from $100,000 to $250,000, which became permanent after the Dodd-Frank Act was signed into law in 2010. Now, the savings and loan crisis in the 80s and 90s really tested the viability of the FDIC. The FDIC stepped in to save failed savings and loan institutions. These are also called thrifts, not thrift stores. A thrift is a financial institution that focuses on taking deposits from customers and using those deposits to provide loans for home mortgages and other consumer needs. The FDIC had a tough time during the savings and loan crisis, but they stepped into the plate and took care of business.
Let's take care of our business.
And there, everyone was able to see just how important the FDIC really was. By the way, if this is the type of information that you like, then it would be great if you hit the like button and subscribe so you get notified of all future videos. Now fast forward to March 2023. Silicon Valley Bank, Silvergate Bank, and Signature Bank all failed within 7 days of each other.
That was fast.
We haven't seen bank failures like this since 2008 when Washington Mutual failed and plunged the country into a financial crisis and a recession.
Let's never do this again.
But these 3 bank failures were different. See, Silicon Valley Bank and Signature Bank failed for mostly the same reasons. The banks relied on customer deposits that in 2020, 2021, and early 2022 were rolling in, but abruptly stopped once interest rates started rising. And instead of new deposits coming in, customers began withdrawing more money than was being deposited. The banks used customer deposit to buy investments, and these were long-term investments that they couldn't sell early without a massive loss. This means they didn't have enough cash on hand to match up with the customer withdrawals. Once Silicon Valley Bank failed on Friday, March 10th, the government had the weekend to do something.
Our main goal is just not to screw up.
There were calls from VCs that they had to guarantee all deposits. So between Friday and Sunday, the federal government met and decided to use the FDIC to guarantee all of the deposits in both Silicon Valley Bank and Signature Bank.
Okay, we're safe here.
But what makes Silicon Valley Bank and Signature Bank so insane is that only 15% of the bank's deposits were actually eligible for FDIC insurance. This means 85% of these accounts had over $250,000.
That's a lot.
The company Roku, they had $487 million in Silicon Valley Bank. Roblox, the online gaming company, had $150 million at Silicon Valley Bank. And you can bet that money wasn't spread over hundreds of accounts. This means that these companies were facing a potential result where all but $250,000 would be completely gone.
Damn.
Imagine going from $487 million to $250,000. And these aren't the only companies. There were thousands of companies who had all their money in Silicon Valley Bank and Signature. But if America really is the capitalist country that we claim, then the government, specifically the FDIC, would step in to ensure up to the legal limit of $250,000. But nope, that's not what happened. The FDIC guaranteed all of the deposits.
That is stupid, yay.
And there are two sides to this. One is if the FDIC did not guarantee every deposit, then there would be larger bank runs. People would be scared that their money isn't safe.
Is it the end of days?
And pull all of their money out of the banks. So to stop the spread of contagion, they had to take this drastic step. Now, the other side is that the law is the law, and the FDIC should only do what the law states. Guarantee up to $250,000 and let the market handle the rest.
Good luck and stay safe.
Companies that had more than the limit of $250,000 would be screwed. The second take, while harsh, is honestly the right way. Because by the FDIC guaranteeing every deposit, it completely removes their significance. Why advertise that only accounts up to $250,000 are protected if in the event of a bank run, all deposits end up getting protected? In my opinion, this effectively kills the FDIC. When you have a law stating that in the event of a failed bank, only up to a certain amount is insured, but then the bank fails and you insure all of the deposits, even those well in excess of the stated limit, what power do you really have? Now, I'm sure people will be in the comments stating how this is not a bailout of corporations, but of depositors, and it's not the same as 2006. But that's a lie.
Stop. You capping right there, bro.
The overwhelming majority of accounts that were above $250,000 were corporate accounts. So this is bailing out companies who did horrible risk management, concentrating a large portion of a company's cash in one bank is terrible risk management, no matter how you slice it. But beneath all of that, what people aren't realizing is that this opened the floodgates to every bank in the country. Think of this. Silicon Valley Bank was the 16th largest bank in the country, and Signature Bank was the 29th largest bank. What if Discover Bank in Delaware, the 28th largest bank, had a bank run? Or what about Regions Bank, the 27th largest bank? Or Ally Bank, the 22nd largest bank? If the FDIC is going to guarantee Signature in Silicon Valley, then any bank from 1 to 30 would have a claim that they should have all their deposits guaranteed too. And want to know what this will lead to? The same exact thing that happened during the financial crisis. The government gave money to the big banks so they could lend it out and get credit flowing. Did that happen?
Nope.
The big banks used that money to pay themselves outrageous bonuses because frankly, they knew they could get away with it. So what are banks going to do now? Are they going to make safer investments and become better stewards of customer deposits? Hell no. They're going to take all those juicy deposits, all of your hard-earned money, and invest it.
And it's gone.
And it's a win-win situation. If the investments do well, they'll make more money, the share price will go up, which will result in big bonuses and compensation packages. And if the investments go south and end up causing a run on the bank, the FDIC will step in, guarantee all the deposits, and the executives who caused it will walk away without any real consequences.
That would be awesome.
And if they're like the CEO of Silicon Valley, they would have sold millions of stock before the collapse happens, guaranteeing them a nice, cushy retirement. And guess who gets stuck? The average person. Because this money isn't coming out of thin air. It's going to cause inflation to go up even more. So the price of eggs, bread, gas, and all the common purchases are going to increase. But the bank heads won't need to worry because they'll have millions of dollars to get by on. But you and I, not so much. That's it for today, guys. If this is the type of information that you like, then it would be great if you hit the like button and subscribe with bell notifications. All right, talk to you later.